Good afternoon, and thanks for joining us. I'm Richard Gigline, and I'll be moderating our webinar today. As we move into spring, Pearl Meyer has identified several compensation issues for your board to talk about in committee meetings this quarter. A quick look at the business section, or even the front page of any recent newspaper, is likely to feature one or more of our topics, which include the changes ushered in by tax reform, the CEO pay ratio, issues of executive conduct, and activist shareholders. Today, we're joined by Bill Riley and Aaron Lehman from Pearl Meyer's office in Atlanta. They have some excellent perspectives and important information to share with us. But before we get into the agenda, Sienna Breen with NACD's education team will take us through a brief housekeeping announcements.
Thank you, Richard. Before we begin, I will go over a few housekeeping items, and then I will turn it over to Bill to start the program. First, if you can hear us but you cannot see the slides, you may need to enable Adobe Flash Player. You should see an icon in the center of your screen where the slides would normally appear. Click on that icon to enable the Flash Player, and that should bring up the slides. Also, if your slides freeze at any point during the webcast, please refresh your browser, and this should solve the problem. On the right-hand side of your console, you should see several boxes. At the top, you can submit a question to be answered by our speakers during the program, time permitting. Please note that if you submit a question, you will be opted in to receive future executive compensation thought leadership from Pearl Meyer. In the middle, you can tweet live with us using @NACD and @Pearl Meyer. And at the bottom, and at the link on your screen, you can download a copy of today's slide deck and access additional resources. You will automatically receive one NACD skill-specific credit for your participation in this live webinar of at least 30 minutes. Credit may be applied to NACD fellowship programs, and you can contact fellowships@nacdonline.org for more details. And just as a reminder, a recording of this webinar, a copy of the slide deck, and links to the provided additional resources will be available early next week at nacdonline.org/webinars and at pearlmeyer.com. Finally, we will have a few anonymous evaluation questions at the very end of this program, and we would appreciate your feedback, so please stick around after the closing slides to answer those questions. And now I'm going to turn it over to Bill to start.
Thanks, Sienna, and good afternoon, everybody. As Richard mentioned earlier, we have a number of topics we'd like to discuss with you. We think these are very timely and of interest to Compensation Committee members. And Richard already identified the primary topics here, but one common theme throughout all of them that you'll hear us reinforce is the importance of communication. It will have implications for all of these, being able to anticipate and respond to potential issues and concerns, and do so both internally and externally. So let's jump right in, and if we look at the next slide, we're going to start in with the tax rate changes and some of the potential implications as relates to compensation. As we know, companies and individuals are now subject to lower tax rates. The alternative minimum tax thresholds have been increased as well, and some of the potential impacts from those changes include perhaps executives will be less likely to defer compensation. We think that incentive stock options may gain favor because going forward, stock options may be less deductible than they have been up until now, and the AMT, or alternative minimum tax, may be less likely to impact individuals depending upon where the income thresholds are. We're seeing many companies provide one-time payments or ongoing structural enhancements because of the tax savings from the lower taxes, and to the extent we have outstanding awards that are in process, it's quite likely that some of the performance hurdles didn't necessarily contemplate the change in tax laws, so certainly adjustments may be required when it comes time to making award determinations, adjustments and or use of discretion. As we think about how companies may respond to the lower corporate tax rate, they can do some or all of the following. They can give some back to shareholders through dividends and buybacks. They can reinvest in the business, and hopefully that will spur additional hiring and growth. Or they can share the wealth directly with employees, and that's going to be our focal point for this first segment here. But I did want to note that we've certainly already seen a number of media articles and commentary, primarily from the Democratic side, that are expressing some concern that perhaps companies are focusing disproportionately more of potential savings on returning to shareholders and not enough on reinvesting in the business or giving back to employees. But if we look to the next slide, we have already had literally hundreds of companies that have announced actions to be able to share the wealth with their employees. We have some high-profile names that are shown on this slide here, and you can see there's a wide variety of actions that companies will take in sharing in this additional cash flow. Some are providing one-time awards, such as special bonuses or equity grants. Many others are making ongoing or permanent changes, such as increasing the minimum wage or enhancing benefit programs or retirement programs. And some are doing a combination. So, for example, within this list you see here, Fifth Third Bank and Travelers and Walmart would all be examples of companies that have increased the minimum wage as well as provided one-time bonuses. Pearl Meyer conducted a survey in January asking companies what actions they had taken or planned to take in terms of sharing the wealth with their employees. This was a fairly comprehensive survey, and we got a little bit more than 300 respondents across numerous industries and ownership types. And if you look at the chart on the right, you'll see that about half of the respondents either had taken action or were likely to take action in terms of sharing the wealth with their employees. Most often, about two-thirds of the time, that action involved a one-time bonus. Oftentimes the value was $1,000 per employee. You can see that slightly less than half of respondents also indicated that they would increase the minimum wage, and then we had lower prevalence for some of the other selections, such as charitable contributions and increasing base salaries. Many companies took two actions, so again, a combination of maybe a structural enhancement as well as a one-time award. Most did not specifically identify a particular sharing ratio to say, for example, we're going to share 15% of our savings with our employees. And in about 80% of the cases, these decisions were reached in conjunction with the board and the compensation committee. Now, it's interesting, when you look at the other half of companies that haven't taken any action, they generally fall into one of two camps. Either they don't anticipate much in the way of benefit from the tax reform, so think, for example, of real estate investment trusts that pay little or no federal income tax, or they feel that the underlying program will already be an effective vehicle to allow employees to share in the additional benefits. So, for example, profit-sharing plans may have higher award pools to disperse, and to the extent that company performance continues to improve, that may translate into higher stock prices, and then therefore anyone who's holding equity awards may benefit as well. So our recommendation is to make sure that you have a game plan in place for how you intend to utilize some of the benefits from the lower tax rates, and be able to communicate that strategy both internally and externally. We're already starting to see and hear that even on the activist side, they're looking for more information in terms of how companies intend to utilize those savings. And certainly on the internal side, many employees are reading these headlines about other companies giving out bonuses and enhancing minimum wage, and so they're likely to be wondering what's in this for them as well. So being able to anticipate those questions, develop a strategy, and respond is very important. And we're going to take a moment just to poll the audience to get your thoughts in terms of what types of actions your company has taken or plans to take in terms of sharing the wealth with employees. We have 7 potential categories here. We've provided one-time awards, like one-time bonuses. We have provided ongoing structural enhancements, such as increasing the minimum wage or raising salaries or enhancing benefits. We've done both. Or we haven't taken any action yet, but we expect to. Or no, we don't think any type of action is appropriate because we think our existing programs will handle it. Or lastly, we haven't had any discussions in this area yet. So let's take a minute just to give everybody a chance to respond and see what actions you're taking or contemplating. I can tell you in some of the clients that I've been working with, this is still relatively new. So many of them have not yet taken any action, but there's certainly been some discussion around it, and I would anticipate some of them will do something in the near future. Okay, so I'm going to go ahead and turn the slide, and we'll see what type of responses we've got. Okay, this is interesting. This is not surprising to me that about a third of the respondents have said it may still be a little bit too soon to formulate a game plan. And the other common approach here, 30% of respondents have said, we think our existing programs are adequate to handle that sharing in the value creation, the tax savings. So fairly consistent, I think, with what we've seen through some of the survey results and client experiences. In terms of the number that have actually taken action, that's a bit light relative to the survey. It looks like it's about 20% of the population. So interesting feedback. Now we're going to switch gears. We're going to talk a little bit about the revisions to Section 162M and some of the implications of that. So by way of overview, the Section 162M provision was initially put in place in 1994 to curb perceived executive compensation excessive pay levels. And it was really an attempt to try to encourage greater use of performance-based compensation. And the rule states that for public companies, their annual tax deduction is limited to $1 million per year for covered employees. And covered employees generally include, or at least at that point in time, they included the CEO and the next three highest paid named executive officers, other than the CFO, who were serving in that capacity as a fiscal year end. And there was an exception for performance-based compensation that met certain criteria that we'll touch on in just a moment. And as is the case with so many types of regulations, sometimes we can have some unanticipated consequences as a result. And many attribute the rise in executive compensation in part to this 162M provision. Many think, for example, that because it increased the emphasis on variable pay, it encouraged the use of the variable pay, that's fine to align pay with performance, but it often comes with upside, so that can lead to some higher pay levels. And there's also the question of the degree of rigor associated with the performance criteria needed to earn those awards. Many companies used umbrella plans, or what we sometimes refer to as 162M enabling formulas, which essentially would typically have some type of financial trigger, some financial threshold that needed to be achieved. And if it was, that would typically fund the maximum incentive award opportunity for those who were considered to be covered employees. And then the idea was that the compensation committee would use some set of underlying metrics to determine actual award levels. Well, sometimes those metrics were not fully disclosed, and so that led to confusion on the part of shareholders and advisory groups like ISS that caused them to question the rigor of those types of funding structures. And again, those hurdles were sometimes not that rigorous, because ideally the companies wanted that trigger to hit, because this was a way to preserve the full tax deductibility and also to maintain some flexibility in terms of the types of underlying criteria that fund awards. And lastly, when the rules said that non-performance-based pay could go up to $1 million, some took that as kind of an unofficial market signal, if you will, that it might be okay to raise salaries close to or even at that level, particularly for CEOs at larger size companies. So we certainly saw a rise in senior executive salaries, and some attribute that to these rules. So now, going forward, the performance-based exception has been eliminated with one caveat. There is a grandfathering provision in place for previously granted awards that are subject to a written binding contract that was in effect as of November 2nd of 2017, as long as that written binding contract or arrangement is not materially modified going forward. Now, additional guidance will hopefully be forthcoming to provide a little bit more perspective on this. But one other change in the rules is now the covered employee will include the CFO, who was specifically excluded in earlier versions, and also it will include anybody who Going forward, anybody who qualifies as a covered employee will continue to do so in future years, even if they're not serving in that capacity. So think, for example, of former employees, former named executive officers who will receive large severance payouts perhaps. Going forward, any payments to them will still be subject to that annual cap, that annual tax deductibility limit of $1 million per individual. And lastly, this rule will apply to a broader group of companies, not just public companies, but private companies that have publicly traded debt and certain foreign private issuers as well. So without going into too much detail, let's just do a quick comparison of what some of the criteria were in order to have awards qualify as performance-based under the Section 162M rules that previously existed. There were some very specific provisions about the timing and structure of goal setting. We know that goals had to be set within the first 90 days or 25% of the performance period. You know that they had to be tied to objective goals that would allow for negative discretion but not positive discretion. They had to be made under shareholder-approved plans that had specific details in terms of what types of metrics might be permitted, what types of adjustments could be considered, and what maximum award opportunities might look like. And they had to be certified by an independent compensation committee. And the company needed to go back to shareholders at least every 5 years to get those material plan provisions reapproved. Now, going forward, since the performance-based exception won't apply, companies have more flexibility in terms of goal setting, both in terms of the timing, in terms of the types of performance conditions, the criteria, the metrics, the use of discretion, with the types of adjustments that are permitted. They don't need to go back to shareholders any more frequently than they need to maybe replenish share reserves under equity plans. And so there's a lot more freedom here in terms of the goal-setting process, which certainly can be a good thing. It can certainly allow for a more holistic assessment of how we view performance and how we measure it. It can factor in certain conditions that perhaps are not reflected in some of the underlying objective goals that we've used in the past, but there are some important caveats here as well that we'll get into in just a moment. So in terms of potential consequences from the elimination of the 162M performance-based exception, one of the things we may start to see more of is an increase in the use of non-performance-based compensation. So, for example, base salaries and time-based restricted stock, because there's no longer a tax-related reason to necessarily have to limit those to $1 million per year. Again, anything above $1 million won't be tax deductible going forward. Now, we've seen one early and perhaps somewhat extreme example of this with Netflix. Shortly after the new rule was enacted, Netflix came out and disclosed that in 2018, its named executive officers would receive significant increases in base salaries, and they no longer participate in the bonus plans. And it's interesting because it really calls into question, what was the purpose of that bonus plan? Was it solely to preserve the tax deductibility associated with that compensation, or was it also intended to really drive performance, to serve as a tool to align pay with performance? So for 2018, the only cash compensation to those executives is going to be base salary. I don't know that we'll necessarily see other companies have the same magnitude of change, but we certainly may see an increase in those non-performance-based components going forward. We also may see a decrease in the prevalence of or the emphasis on stock options because they won't necessarily be fully deductible going forward. Under the old rules, companies would almost always be able to have full deductibility for non-qualified stock options as long as they were granted under a shareholder-approved plan that had designated maximum levels and the exercise price was at or above fair market value. Going forward, again, the options will not be exempt from that $1 million cap. And to the extent companies start increasing base pay, there may be a ripple effect for other types of incentives or benefits that are tied to base salary levels, unless those multiples, those target bonus opportunities, long-term incentive target opportunities, unless they are recalibrated, we may start to see that compounding effect in terms of other pay components as well. In terms of goal-setting practices, again, we think that there's the opportunity for companies to be much more flexible in terms of the types of metrics they use, when they set those goals and finalize them. Again, we don't have to have a pre-identified laundry list of goals that we can select from. We can consider other criteria. We can consider adjustments that have not been pre-identified as well. We expect that companies may make greater use of discretion, both positive as well as negative, and we may start to see an increased emphasis in some of the non-financial individual goals, strategic goals, some that may be more qualitative in nature, subjective assessments, because again, we're not confined by the performance-based exception provisions as relates to goal setting. And we may also see some companies use longer vesting periods or longer deferral periods to try to spread out when that income is recognized so that they can try to maximize their deductibility under the new rules. And as we mentioned before, under this once met, always met type of criteria as relates to covered employees, this could also apply in the case of severance to former employees because, again, they will be subject to that $1 million per year cap. And so our suggestion here is to be prepared to think about ways you can take advantage of the additional flexibility as relates to goal setting and viewing performance more holistically, make prudent use of discretionary adjustments, but make sure it's not at the expense of the alignment of pay for performance, and also that it doesn't adversely impact the motivational impact of incentive plans. Because if we want to promote that, do this, get that type of mentality, the longer we wait to finalize goals and communicate the goals to our participants, that will weaken that motivational impact. So now we're going to ask for a little bit more audience participation again. We're going to ask you to weigh in terms of your thoughts in terms of the 162M revisions and how they may impact your company's executive pay practices. So we've got 5 choices here. The first would be we did or we may increase the emphasis on our non-performance-based components such as base salaries or restricted stock. We may make greater use of discretion within incentive plans, or maybe both of the above. No anticipated change in plan design or pay practices, or too early to tell. And so please take a minute to go ahead and respond. I can tell you in terms of some of my client experiences, I have had a number of clients that have started to think about introducing more qualitative measures into the mix, particularly on the short-term incentive side. But again, many are still in the process of evaluating all of this and seeing to what extent it may impact their pay practices. We don't expect a wide-scale jump to significant enhancement in pay levels, given the ongoing scrutiny on executive pay practices. So let's see what kind of responses we've gotten. Okay, this is interesting here. This is actually what I would have expected. We still have many that are still in a evaluation, early stages of evaluation, or thinking that we're comfortable with our current structures and processes, and so no anticipated changes in plan design or pay practices. Again, this will be a story that will continue to play out as we get forward and throughout the year. So just to recap the Section 162M discussion, we want to leave you with a couple of parting thoughts on this. First of all, compensation committees will still be accountable for ensuring an appropriate alignment between pay and performance. That's going to continue to be a best and expected practice on the part of your shareholders, as well as all of the institutional advisory groups like ISS and others. They're not necessarily going to change their policies because of the tax law changes. They're still going to expect to see that linkage. And certainly you may find that you have the opportunity to make greater use of discretion in terms of trying to match up award outcomes with performance and events throughout the cycle. And to the extent you do so, it's important just to remember you will still have that scrutiny, and it's important to make sure you provide an appropriate rationale as to why the discretionary actions that you took were appropriate and aligned with performance. And as we have so often said, the proxy, the CD&A, is really an excellent opportunity for companies to tell their story and to explain why the actions that they took were appropriate. And by the way, for what it's worth, the advisory groups like ISS, they are still not big fans of discretionary awards, and some of the flexibility that you'll have in terms of the goal setting will have to be balanced against that. Similarly, when it comes to plan design, because the performance-based exception has been eliminated, theoretically it will be possible to remove some of the individual grant limits that you have within your plans. But just keep in mind that ISS has already hinted that they may look unfavorably on those types of actions. Anything that removes any type of governors or plan limits, they may view unfavorably. And as a further protection against the temptation for abuse or excessive discretion, companies will still be subject to annual say-on-pay votes, and we know that the scrutiny on executive pay continues to intensify, even more so now that we have the CEO pay ratio disclosures coming into play. One other comment that we found interesting was we expect that in most cases discretion is probably going to be more prevalent as relates to cash compensation versus equity-based compensation. And that's because, based on our understanding of the accounting rules, in order to qualify for a grant date and to have fixed accounting treatment, you need to have a known number of shares, you need to have an objective set of criteria and vesting provisions that are established and communicated to participants. If you don't, then variable accounting may apply, and that can be, of course, a very unpredictable and volatile expense that most companies may try to avoid. So you should certainly discuss that concept with your auditors, but just keep in mind we still expect that when it comes to performance contingent equity grants, we'll still see objective goals. And now that we have that once met, always met provision as relates to covered employees, companies will need to keep track of them, even after they're no longer employed by the company. If they're still receiving severance, they're going to have to track that and make sure that they take that into consideration when it comes to deductibility. You know, for many of the incentive arrangements that were intended to qualify as performance-based under 162M, the payouts had to be tied to actual performance outcomes. There was an exception for death and disability and change in control, but not for other types of termination, such as termination without cause or voluntary termination for good reason or retirement. So going forward, now with the elimination of the performance-based exception, it may be possible for companies to start having those vesting acceleration criteria be based on target pay as opposed to actual pay in those cases, without cause, good reason, and retirement. And that doesn't mean that companies should necessarily do that. We're not advocating that, because certainly many still feel that the best and most appropriate practice would be to continue to tie those awards to actual performance outcomes. It has that alignment between pay and performance, and it also keeps a somewhat consistent experience versus others who remain employed and continue to participate in those programs throughout the entire performance cycle. And lastly, companies will likely revisit their incentive plan languages. Committees will revisit the language in their committee charters and may decide to remove any and all language related to 162N and all the various provisions. And that's certainly fine to consider doing, but you just want to be mindful to ensure that you don't in any way jeopardize the grandfathered treatment that may apply for some outstanding awards that are already in process. So again, you're going to want to discuss that with your tax counsel. So with that, I'm going to turn it over to Erin to talk about the CEO pay ratio.
Absolutely, Bill. Everybody's favorite topic. We all hoped it would go away, but it did not. So the CEO pay ratio disclosure became effective for the 2018 proxy season. Early filings have confirmed what we expected, that these CEO pay ratios are really going to vary quite a bit based on the industry, your workforce composition, and the company size, whether it be on a revenue or a number of employee basis. And if you look over at that chart to the right, Pearl Meyer is actually tracking disclosures as they come out. This data set is made up of 178 companies, but we will be updating this data set weekly on our company website. So if you just go to Pearl Meyer's website, there's a button that says CEO Pay Ratio Watch, and you'll be able to get real-time analysis on how these ratios are coming out for each industry and each revenue size bucket that you see here today. What we're seeing from common disclosure around these CEO pay ratios is really it's a brief narrative format that's outside of the CDNA. It's not being included in the CDNA. It's typically coming right after that. And there's usually a statement, a caveat of some sort saying that the ratio may not be comparable to other companies because there's quite a bit of flexibility that was built into the methodology of these calculations. Some other companies have also made the decision to disclose multiple ratios, and really what you would see in those cases is if the CEO, for instance, got an upfront one-time grant that was meant to cover a multi-year period. You'll see the calculation as it is required using the summary compensation table figure for the CEO, but then you might also see an alternative disclosure that would be annualizing that upfront grant out and, just something that the company would feel would be more indicative of what their ratio will look like going forward. So it's going to be quite a bit of a balancing act. You don't want to make it seem more important than it is, and if your company is fine with it and just want to disclose it and get it out of the way, that's certainly probably the mainstream thing that we're seeing as far as these disclosures go. The other really problematic thing that we are seeing is media coverage, and this is also very much expected. So media coverage has been emotionally charged, inflammatory language, words like enormous, obscene, gigantic, many lifetimes worth of compensation. So what boards really need to do, and companies, is just be ready. Everyone should have talking points on this topic. So there should be 5 bullet points that if this comes up, everybody is sharing the same message. It should be uniform, simple communication so that anything that comes out of the company, whether it be if they speak to somebody, an executive at the company or a board member, you have consistency across the board. And so an example of this might be if you operate call centers in a lower wage part of the world, your ratio is going to be higher than if you're a U.S. professional services company. And, that U.S. professional services company, they might be located right next door. And so what we're really seeing is another expected result are local newspapers coming out with really comparisons of companies that are headquartered in the same city, but not at all in similar industries, and certainly not the same size company. And so that's really what you're going to need to be ready to communicate and really combat against. And as these newspaper articles come out, it will become more visible to your employee population as well. We still don't see this as being a shareholder issue. It's really a media and employee issue.
And I would just add, Erin, that the Wall Street Journal recently had an article that talked about how the whole methodology around the CEO pay ratio is somewhat flawed, where some ways we're comparing apples with oranges. And, for example, you cannot annualize the compensation of part-time employees. And so to the extent you have a lot of part-time employees, you're comparing their pay, particularly if they wind up being the median, against that of a full-time CEO. So these ratios, because of the difference in workforce composition, they really were not necessarily designed to facilitate comparisons, particularly across industries, but even across companies within the same industry as well.
All right, so now we're going to ask for a little bit of interaction here and just try to get a sense of what is your biggest concern regarding the CEO pay ratio at your company. So is it shareholder reaction? Is it the media reaction that we just talked about? Is it the employee reaction once these media articles start coming out? Or is the board really not concerned and don't anticipate it being an issue? Bill, have you seen any of your clients really be getting very concerned over this, or what would you say your percentage of?
I have not. When this topic has come up, most have said we're fairly comfortable that our employees are familiar with our program arrangements and are generally comfortable with the system. But this, of course, this is before the media articles started coming out. So if they wind up a subject item in an article, they may feel differently.
That's exactly right. I haven't seen a lot of concern around it yet, but yes. All right, let's see what everybody's seeing. Okay, so we've got about half of our population on this call today really most concerned with the employee reactions surrounding the CEO pay ratio. We would expect that the shareholder reaction bar is the lowest, and that was our going-in thought around CEO pay ratio, and not really concerned and shouldn't be an issue. So that's good news event. It shouldn't be an issue. It's as Bill said, it's not really a meaningful ratio, and it's very hard to compare. So we will move along to Spotlight on Code of Conduct. We're covering all of the exciting topics today. So scrutiny on code of conduct at companies has significantly increased in light of the recent high-profile sexual harassment cases and the Me Too movement. And what we want to talk about a little bit is, yes, this is front and center because of sexual harassment right now, but we really want to talk about all misconduct. And so in keeping with fiduciary responsibility, boards are really starting to play a more active role in ensuring that they have the correct procedures and policies in place so that they have a safe and open working environment for their employees. The shareholders and governance groups are also coming out and saying that they expect for the boards to be playing this active role and to be really ensuring that procedures are in place. There's a growing call among governance groups to ensure that misconduct is not rewarded in incentive plans and that the incentive plans reinforce the corporate culture. And so we're really seeing this come through in cases, in any misconduct cases, but there are big financial implications for companies if we don't have our code of conduct and our corporate culture in the right place. We've seen it with recent instances with Wells Fargo. We've also seen recently with Facebook, $60 billion in market value lost in a matter of a few days.
Yeah, that's the thing, Erin. So often we think about the fiduciary oversight of the board, and there's a lot of focus on strategy, and appropriately so. There's a lot of focus on the financial aspects and financial reporting and having all of the right procedures in place. Sometimes in the past, what might have gotten lost in the shuffle is kind of that cultural oversight as well. And now with all of these developments, as you mentioned, it's really demonstrating that these can have a very significant impact, not just reputational risk, but even financial risk to the company itself. And so we're seeing more and more boards get much more actively involved in digging in to make sure that adequate safeguards are in place. And that Council of Institutional Investors publication that you referenced, they've laid out a number of suggested activities that boards need to look into to make sure that this due diligence is correct. And they include like having adequate staffing, having diversity among your workforce, but also an independent and diverse board as well, to make sure that you can handle that fiduciary responsibility appropriately.
Richard, are you seeing any increased focus on this code of conduct issue on your boards?
Well, actually, Erin, I'm seeing and listening to a lot of people talk about it, particularly as you think about the industry that I spent most of my career in and continue to have some interface with, i.e. that being gaming. Not exactly an industry that has a great historical record on various kinds of conduct issues. I think it has become one that people are starting to pay a lot of attention to, and making sure that they have well-articulated codes of conduct in writing, and that they really go out of their way to educate their employee base to understand what those codes are and what various paths they can take when they feel something has been violated in terms of those codes.
Okay, well, it can seem like a very broad topic, really, for the board, but there are certainly tangible and tactical actions that can be taken to really protect the board and the company and the employee population. And so we've listed out a couple of things that are compensation-related actions that could be taken or at least considered and discussed on the boards that you serve. And the first one of those is reviewing the employment and severance agreement provisions to really drill down and look at that for-cause definition. So we want to make sure that we're specifically referencing different types of misconduct and how we want to define these types of misconduct. And I will go ahead and caveat all of this by saying all of these, any changes that you're contemplating should be addressed with counsel, because we are certainly not attorneys. But we are seeing clients starting to really look at these for-cause definitions and make sure that they are in place and really providing the protection that we want to provide. The other thing that we're starting to see with some of our boards is, and this goes back to 162M, now that we have a little bit of flexibility, is within the incentive plans and really the short-term incentive plans, a lot of times there's an individual or a strategic portion of the incentive plan. And what we're seeing is some companies are allocating a piece of that individual or strategic measure to something like diversity or an employee satisfaction metric. And really that will help create focus and alignment with the executive team and the board and set expectations that we really do expect ethical and good conduct from our executives and lower down in the ranks of the organization. Lastly, companies are starting to take a look at
Aaron, let me just inject something at this particular point. I think the other thing that at least companies that I'm involved with are starting to really look at what their culture, their leadership culture is, how they've been leading and how they've been governing their businesses. And I say that because particularly when you think about in industries like gaming or hotels, restaurants where you have a very large employee base, and you think about the changing demographics where the millennials are now 87 million people and clearly are going to become the largest employment segment. And those people in general are really not aligned with command and control leadership or, take names, my way or the highway kind of leadership. So at least the boards I'm on are starting to think about and talk about how do we realign, how do we move into a more literally collaborative kind of a leadership environment than we've historically had.
I think that's great perspective and certainly top of mind for a lot of companies right now from an attraction and retention of the millennial population. Yeah. The last thing that we are really seeing from a board action and a comp committee action is just going back and looking at our clawback policies that we have in place. So even if there's no direct financial loss or financial restatement, does the company have the ability to claw back payouts to executives if there's any type of misconduct? So sexual harassment or really any type of misconduct that goes along with this. And to Richard's point, communication is really going to be key. So not only trying to reform your culture, but communicating your expectations with your employee population. And so that may be revisiting your code of conduct. Everybody signs these on their first day of work, and then they usually never see them again. And so maybe bringing that out, refreshing it, making sure that you've clearly defined expectations within the company. That's another way to communicate and really get this back to front of mind.
Yeah, I definitely agree, Aaron. I just think it's important to have safeguards in place to ensure we're fostering a safe and open and diverse workplace, and that we have this no tolerance policy towards misconduct. Again, we don't want to lose sight of due process. That's why some of the language in here is making reference to due process and proven instances of harassment that are in direct violation of policies, but really just having the flexibility to give the boards and committees the opportunity to take action so that offenders don't wind up leaving the organization with big severance checks, which some may view as really not discouraging that type of behavior.
So we're going to take a minute and ask for some feedback here. Has your company taken any of the following actions to address sexual harassment or misconduct? So we've got reviewed and or modified employment or severance agreement language, added incentive plan metrics that are tied to culture or employee satisfaction, no actions have been taken because it's not a concern for us, or we just have not yet addressed this. It's a pretty new topic, so a lot of companies might not have had the chance to talk about this. Q1 committee meetings are typically pretty packed, so this might be on the agenda for the next meeting.
I know, Erin, you've had a couple of recent client experiences where this topic has come up.
I have. I've seen a big increase in focus on diversity, and it's a lot being driven by my more diverse boards that I work with. The more diverse the board, the more focus it seems that the board has on these types of topics.
I've seen that too. I've had a number of diverse compensation committees that have really decided to dive into the details and ask all of the questions to make sure we have the right processes and training and hotline and everything else in place to accommodate these types of issues.
All right. Okay, so we've got what we would expect coming out of Q1 board meetings. We haven't yet addressed this as our most common answer here at 60%. We also have quite a few companies that have reviewed and modified employment or severance agreement language. So that's good to see, and then it's also good to see that a lot of people don't think it's a concern, because that means you have good culture in place, hopefully.
That's right.
All right, and this is our last big topic here today is going to be shareholder activism, the new normal. Shareholder activism has really been evolving in recent years. It used to be a niche strategy that was really pursued by high-profile hedge funds, and it's now become really a widely accepted approach from institutional shareholders, hedge funds of varying sizes, and really going after different size companies. It doesn't have to be a large, high-profile company that these activists are going after. Bill and I were just talking about that a lot of small companies are getting a lot of activist attention at this point in time. I think the big scary number, shocking number on this page is if you look down to the bottom left, 46%, so nearly half of these activist campaigns have earned at least one board seat, and so that's up quite a bit from 29% in 2012. So these activists and shareholders are not, you can't ignore them anymore. So this is another communication message here. You have to engage and listen and respond appropriately as a board to the activism that's going on, or you'll likely end up with the activists sitting on your board.
Yeah, and you know, Erin, when you look at some of those common themes among activists, oftentimes they have to do with M&A related issues or strategic issues, but they are more and more they're getting into governance issues as well. You'll see that and these are not intended to be ranked in terms of priority necessarily, but executive compensation is also on the list. Oftentimes that is not the sole cause for attracting activists, but it can certainly add fuel to the fire. So as you think about your executive pay practices, again, we don't endorse following the herd mentality, but you also want to be mindful that your practices are not so egregious to be so far out there that they might garner some unwanted attention.
And just a recent example of success with the activist shareholders is Newell Brands just gave 4 board seats to Carl Icahn. He's actually putting up a 5th board member for a vote. And that was really to fend off Starboard. And Starboard was coming in to try to take over Newell Brands in a very, in kind of their way that they tend to do it. But Carl Icahn came in with 6.9% of the stock and got 4 board seats, which is way more than one that we've called out here at 46%.
And so we'll just wrap up this segment by just talking a little bit about recent disclosure of this new model of shareholder engagement that BlackRock had come out with. And it's really indicative of that theme, as Erin was talking about, the increase in shareholder activism as the new normal. It used to be that it was just a pre-identified group of activists that might come in and agitate for certain causes, and now we're seeing much more so even the passive institutional investors and asset managers. They're feeling much more beholden to be more responsive to their own clients in terms of their causes and concerns, and so they're really looking to step up the magnitude of outreach that they have with the companies that they invest in. And so when you look at this new model of shareholder engagement, and you see what BlackRock is saying it's expecting of itself and what it's expecting of companies, it reinforces the notion that, again, they're calling for more dialogue, something that becomes more routine rather than companies operating out of crisis mode. After a proxy has been filed and maybe ISS and advisory groups are recommending against company proposals, or maybe they're endorsing shareholder proposals. They're saying that's a missed opportunity to be acting from that position. They should have an ongoing, regular dialogue with companies to discuss some of these issues. And it's interesting when you look at the expectations of companies, they're saying that they're looking for companies to articulate their strategy and how that will translate into long-term value creation. And by the way, this also pertains to the recent tax law changes and how that's going to translate into value creation as well. As we mentioned earlier on in the discussion, that's why it's important to be able to have this strategy and be able to articulate it. But interestingly enough, they also want to make sure that the board is well versed in strategy, as they certainly should be, and that they're able to talk about it, they're able to describe it. And they are saying that in order for the board to fulfill its fiduciary responsibilities, they need to have sufficient independence. They need to have sufficient diversity, as you can see here, in terms of gender, ethnicity, in terms of background work experiences and the way that they approach problems. And so again, they're looking for companies to be more accountable, not just in terms of value creation through TSR and financial results, but also taking more of a leadership role in these various environmental, social, and governance matters as well. And even Vanguard, which is very passive, they manage index funds largely. They increased their shareholder engagement by 39% over just the last couple of years. And there's a quote from their CEO who is saying that they're looking for diverse, experienced boards that can serve as their eyes and ears on risk. So again, that whole notion of risk and fiduciary oversight that goes beyond strategy and financial issues to governance issues as well. So we're just going to wrap it up now in terms of some key takeaways from the various topics we've been discussing. And so the first item is to maximize the return on investment tax reform benefits, as we said. Make sure that you have a plan in place for how you intend to utilize that increased cash flow and that savings from the lower corporate taxes. Again, companies will ideally be doing a combination of things, such as giving some back to shareholders, reinvesting in the business, and also sharing the wealth with employees. Some type of balance would likely be preferred. As far as the unintended consequences of 162M, again, it's that whole notion of embracing the ability to view performance more holistically and having more flexibility, but not at the expense of paying for performance and ensuring the motivational impact of your incentive plans. And again, to the extent you're using discretion, make sure that you provide an appropriate rationale and you communicate that. Be prepared for CEO pay ratio noise. And I think it's fair to say, based on some of the early indications, that you can expect some significant media reaction. Our perspective is that you need to be able to anticipate and be prepared to respond to the concerns of a variety of constituents, both internally and externally. We all know, or most of us should know, that the CEO is typically going to be the most highest paid person in the organization. What's new here is this is the first time that we are actually disclosing the median compensation level for our employees. And by definition, half of our workforce is going to be paid below that level and half is going to be paid above. And it's quite possible that some of them are going to have concerns about why they are, how their pay compares to the median pay. And so it's going to be important from an internal perspective to make sure that your HR staff and your supervisors are adequately trained in terms of understanding the compensation program and being able to respond to concerns, noting, for example, that the program is intended to promote internal equity, that our pay opportunities are calibrated against objectively benchmarked external benchmarks that recognize tenure, skill qualifications, job responsibility, and that the whole purpose of this is to appropriately align pay with performance. So anticipate that noise, be prepared to respond. Align executive incentives and policies to strategy and culture. We talked about that before. We certainly want to make sure, we're firm believers that the compensation program design ought to reinforce the company's business strategy and its talent management initiatives, but certainly you want to make sure that you have that cultural fit as well. And as we talked about, this is an opportunity with the revisions in the tax law and companies considering more qualitative types of metrics to think about some types of actions to promote the desired corporate culture, whether that be additional metrics and incentive plans or other considerations, and also taking actions to ensure that we're promoting a safe, open, collaborative, diverse workforce, and we have a no-tolerance policy towards misconduct. And then lastly, improving shareholder engagement is key. As we just heard, many of the institutional shareholders are really expecting more outreach going forward, more regular outreach, not just operating on a crisis mode. And we find that the general thinking is that the earlier you anticipate and are prepared to respond to potential issues, it can materially improve outcomes, whether you're approached by activists or whether you're approached by other parties as well. So you see here, the common theme throughout all of this is adequate communication both internally and externally. So that concludes our presentation. We're happy to respond to any questions that the audience might have.
Well, Aaron and Bill, we've in fact received a number of very good questions, so let's just move into that. First is, has any research been done on whether successful activist actions have actually resulted in improved long-term results for other shareholders?
You know, that's a great question. I don't have any research, readily available. There may be some. The knock on activists so often is that they have such in many cases, they have a short-term time horizon in terms of the way they're thinking. In many cases, they're looking for a quick fix, a fast buck, and that's why when you hear, for example, that activists are concerned about what's the strategy for utilizing some of the savings from the lower tax rates, oftentimes they're probably looking for getting some of that funneled into immediate returns to shareholders as opposed to necessarily making additional enhancements to invest in the business and grow it and spur hiring. So it's a great question. We can certainly look into that to see if there's any research on that.
Great. Another good question. How long would a former named executive officer remain as a covered individual?
Well, based on our understanding, for as long as they're continuing to receive compensation from the company that generates any type of tax liability, the company will be subject to that $1 million annual deductibility cap. And so if you're paying someone out in installments over a number of years, they'll continue to be a covered employee.
Wow. Well, here's a question that particularly resonates with me coming out of industries with large number of part-time employees. The pay ratio requirement does not allow for equalization of a part-time worker's pay to a 40-hour scale. Do you think companies should add such a calculation in its disclosure?
I think that's an interesting question, Richard. You could certainly add that as a supplemental ratio that we had talked about a little bit earlier. I think the complexity behind going back in and re-identifying employees to really calibrate that and get everybody on a 40-hour a week, it might be worth less than the amount of work that it would cause. But if we think that it's a material supplemental disclosure that we want to have in our proxy statement, and we think it's necessary, then that could certainly communicate. But if you look at these industry breakdowns and you think that you're kind of going to be pretty well aligned with everybody in your industry sector, I would say that might be a little bit more work than it would be of value.
And our hope is that.
Go ahead.
Go ahead, Richard.
Well, when I looked at that graph that you had together with various industries showing the percentage ratio, and you looked at the one that the hotel, restaurant, and gaming industry would be in, and it's like 300 or 400%. And then I think about the huge number of employees that literally don't get calculated into that. I think it's sort of not a very fair evaluation. I guess I'd put it that way.
Yeah,
absolutely.
And our hope, Richard, is that as we get more experience collectively under our belts in terms of this whole process, that hopefully there may be some additional revisions going forward that would, for example, allow for some type of annualization to put part-time on more of an equivalent, a full-time equivalent for purposes of these ratios.
Okay. Does the pay ratio requirement in any way allow for equalization? You just really can't do it, or can you go ahead and do it and just explain how you did it?
You really aren't allowed to, from an annualization perspective, you can't bring a part-time worker to a 40-hour a week. That is not allowed under the rules of the calculation.
Okay.
So, yeah.
Yeah, you can take a permanent full-time worker who started during the year and annualize compensation, but you'll have to do it collectively for everybody. You can do that, but the seasonal folks, the part-time folks, you can't annualize for them, at least based on our understanding of the current rules.
So you couldn't play a GAAP, non-GAAP kind of a game with this thing.
Well, I suppose you could make some type of disclosure, but it wouldn't be consistent with the specific requirements that were laid out by the SEC. And, that's the other thing about all of this, not only the differences in the workforce, but there's a fair amount of latitude in terms of the procedures and assumptions companies can go through in terms of how they identify their median employee, which further makes comparisons difficult across companies.
Okay, well, I see that we have managed to run out of time. We do have a number of unanswered questions, and for our participants, I want them to know that their questions will be responded to in the next week or 10 days. So at this point, let me turn the program back to Sienna Breen for her to provide some wrap-up information.